Good morning, everyone, and welcome to the Camp Financial Stock Market Update. So today it's June the 7th. I'm going to do the video a little bit different today. We're going to focus on a recent email that I got. I get a bunch of different emails. I follow a bunch of different stock and investment people, and so I'm always trying to glean some ideas. There's so many stocks in the investment world that obviously we can't all track them all. So what I like to do is when I get an email or get some kind of an indication on a certain stock, I want to take a look at it and see if does that stock make sense for me, or do I agree with this person's thoughts on the stocks. So with that, I'm just going to go over one article, I guess, that was based on dividend stocks to buy right now. So dividend stocks that are gonna, well, I don't know if he doesn't really say, like why you'd want to buy them now or how long you're gonna want to hold them, or and I don't blame him because everybody, it's different for everybody. Sometimes it makes sense to buy one right now, hold it for a year, make the dividends, get out. Sometimes it needs to be a longer term thing, and that's kind of what I'm thinking. Some of these are probably a longer term thing, but with some of them, I wouldn't want to get into them right now because they're pretty fairly valued. They're strongly valued based on all their historical tendencies around the stocks and that sort of stuff. So with that, let's go ahead and get into it. So we'll start. Let's see. So we'll start with the one I like the least out of all the recommendations in there. So the first one is Centerpoint Energy. Ticker symbol is CNP. Okay, so sure, obviously you've already started to think CNP, Centerpoint. So what do? So they provide energy, power, electricity, and natural gas to across the U.S. They're in 32 states, but they're based out of Houston, right outside the Eagle Ford Shale, and right now pays a 3.7% dividend, which is pretty good. I think that might be ahead of the broader market. But the thing is right now they're very, very heavily valued. They're currently trading at 26 times earnings. Their PE ratio is 26.62, with a forward PE of 22.12, which indicates obviously that they're projecting some real growth this year in earnings. But here's the deal. So historically, their PE ratio has been around 15. So even at 26, 22, we're still talking about a company that's definitely got to grow to get what would be considered in the norms for an energy stock. And so with the 3.75% dividend yield, with that kind of valuation, I wouldn't be interested in buying right now. I'd want to see it pull back to, I'd want to see at least maybe a 40, probably it's 25 to 30% pullback before I would think about it. That would get it in line, pretty much with the with their forward PE around their historical norm. And at that point in time, your dividend yield goes from 3.75 to about 5%. So, Centerpoint Energy, one on his list. I like the dividend, I like the company, I like what's going on, but I'd hold off on buying that one. We'll go to DTE Energy next. Again, another energy stock based out of Detroit. So they do a little bit of all kinds of power. They do gas, utilities, natural gas, and let's take a look at DTE. So DTE, its current PE ratio is 19.39 versus again the 10-year average of 15. So it's closer to fairly valued. I definitely would like to see a pullback here again before you buy. It's currently at a 3% dividend yield. I think their forward PE may be just a little better. Let's take a look. And actually, no, so their forward PE is actually lower than their trailing 12 month of 19.39. Their forward is 20.83, so they're actually not expecting growth. Analysts, I should say, are not expecting growth in this stock. So with that, this would definitely be one I want to hold off on. 30% pullback for sure on this one with no growth in earnings. You don't want to just get it stuck into a stock. It's going to kick out 3% dividend yield. I mean, that's great. But your goal should be to make more than 3% in the market in a year. So again, I'd hold off on that one. Let's take a look at Boeing next. Boeing is one that it's again pulling back. It's been pulling back right now. I'd probably want to see about a 10%, at least a 10% drop after it hit that high of 191 bucks. It's dropped off now to what, just under 187. I'd want to see it drop another 10% or so before I'd look at it. So I'd be looking at probably it not wanting to buy until it dropped to at least $169. So it drops a little under 170. Then I think you've got a stock that's primed to go higher again, and again you're going to get a 3% dividend yield while you wait. So that's one with a 10% pullback that it'd be time to pull the trigger. So it's not far from that, and that could happen at any point in time. So now we'll take a look at the Permian Basin Royalty Trust. I like these royalty trusts. I know some people don't. Some people love them. Some people, it is what it is. So they have to pay out. Let's take a look. So their ratios are, their PE is at about 17.33. They don't do a forward PE, anything like that for this type of company. They're paying 6.35% dividend yield. Again, we probably would want to see about a 10% pullback, would put it close to where we would want to see it. Maybe more like a 15% pullback on Permian Basin. So right now it's trading right around 10. If you could get in this between around $8.50, I think you've got a good buy point. It was just it was just there right toward the end of January. It was trading around $8.50 a share. It's run up 15% since then, so it could easily turn back around, drop down there. And then what you want to do is you want to find a spot where it's kind of leveled out before you would pull the trigger on going long. So now let's take a look at the three that I do like the most. So now we got to the last three that he recommended. And the first one is the Arbor Realty Trust. REITs are tough right now. Everybody's kind of funneling into them for yield because there's no bond yields and that sort of stuff. So Arbor Realty Trust, they focus on the financing part of real estate and finance. What they do is they finance property, so it might be hotels, apartments, offices, commercial space, what have you, which is a pretty good business right now for the time being until we see what happens with the rest of our economy. But I like it. It pays an 8.7% dividend. I don't really see it fluctuating much in price. It kind of just is where it is, and with real estate, with all the REITs, real estate investment trusts, they have to pay out 90% of what they earn by law. So it's pretty fairly valued historically. Right there at $8. I mean, I would have no problem pulling the trigger on that one today. Another one we've got is another REIT, and that is Armor Residential. The ticker symbol on that's ARR. Again, here it's pretty. It's actually valued well below historical norms. It's paying almost the 9% dividend yield as well, so it'd be pretty easy to make 10% on this stock in a year. Let that dividend compound, and it could grow into something pretty substantial pretty quickly. The one thing to remember with that stock is again, it's more of the financing side. So they manage a portfolio of mortgages that are Fannie Mae, Freddie Mac, and Ginnie Mae. So if you remember the market crash in 2007, it was driven by housing. I think that we're okay right now. So I don't think housing is getting too out of control yet. Prices are starting to spike a lot higher, especially here in Central Ohio. But I think that this is one that that can definitely continue to go higher, or again, even if it doesn't go a whole lot higher, you're going to compound almost 9% dividend. And now to the most controversial one that he has on his list, and that's Alliance Holdings. So from what I'm seeing, I mean, it's up almost 50% in the last year. It still has a lot more room to run. I think I can see it. I mean, I actually could see it going up almost another 100% from here. It does pay an 8% dividend. So, it's a strong company. They're fundamentally strong. They're doing the right things. Here's the scary part. It's a coal stock. I listened to one guy, and he always talks about how he refuses to trade Apple because he's been burned on it so many times. This stock scares me because I've been burnt buying coal stocks before. So actually, it wasn't a stock; it was a bond. But regardless, I still recovered some of my money, but the company filed for bankruptcy, so I was converted into a shareholder, and they've come back out of bankruptcy now, and I have small shares of this company, but coal companies scare me. So with that, I mean, it's primed to do well. It's just a matter of whether or not it can get the support of the White House, essentially. I mean, Trump, we know, is a proponent of coal. So if he continues to support the coal industry, then you can definitely see Alliance Holdings moving a lot more up here in the next year or two. And again, it pays an 8.12% dividend. So even if it doesn't move up much, as long as it's not traveling down, which I don't see that happening on this stock, you're collecting almost 8% a year, which makes it a nice holding in your portfolio. So alright guys, that's it. Like I said, figured I'd do something a little bit different today, just going through some of these emails and letters that I see. So if you have any questions, send me an email, chrism@campfinancial.net. You can always send me a note, something on Twitter, @cmelik, or on Facebook as well, Chris Melik, and we will see you next time. Take care.